So welcome everyone for this session with Bjørn Jørgensen from the Copenhagen Business School. Today, he will present a paper, accounting-based evaluation with inter-firm information transfers. So it lasts 1 hour. The first 5 minutes are uninterrupted, and then you can ask questions through the chat or use also the raise hand option that you might know by now with all the Zoom meetings going on. Yeah, you have the floor.
Thank you very much. Let me start by sharing screen and make sure that that works. Is that visible?
It's perfect.
Thank you. So this paper is joint work with Daphne Hart from University of Illinois at Chicago, and it is about accounting-based valuation in a setting with more than one firm, because we wish to study the information transfer between firms. But before I get into the paper, I want to make sure that I make the announcement for the next seminar in this series. And please note that this is, pardon my pronunciation, Guchang Sheng, who will present Thursday, December 2nd at 9 a.m. to 10 a.m. And please note that that's Eastern time, and it's a different time than the usual time slot. Now, Daphne and I are motivated by the fact that accounting-based valuation models generally consider a single firm in their setting. And in one seminal paper by Jim Olson from 1995, he introduces the assumption of linear information dynamics. So Daphne and I were motivated to pose the question, what might we be able to learn by expanding the existing models of accounting-based valuation models to 2 or even more firms? And that motivating question led us to make the following considerations. First of all, when you have more than one firm, you have to deal with the issue that what Olson calls other information, about which he makes the assumption about linear information dynamics, LID. With 2 firms, you have to decide if that other information is either common to both firms or firm specific. And second, when you have more than one firm, when you have 2 firms or more, you can start to form portfolios and investigate what are the characteristics of the stock returns predicted from the model. And when you do that, you can decide to minimize the exposure to shocks or to minimize the exposure to common shock. And the first type of shock is the shock to the abnormal earnings, whereas the second type of shock is the common shock from the other information innovations. And so we use the word shock or innovation interchangeably. And in addition to those considerations, we also set out to investigate how we would value firms that face unique circumstances. And we consider 2 settings. First, we build an accounting-based valuation model that applies to a setting where firms disclose with a different frequency. For example, US firms must disclose every quarter, but European firms are only required to disclose earnings and book values every half year, semi-annually. So we enter into the exercise of valuing firms when one firm discloses quarterly and the other discloses semi-annually, and give predictions for empirical work in that area. In addition, we consider a second setting. We consider a setting where one firm used to be publicly traded and used to disclose with the same frequency as its peer firm. And in that setting, we ask ourselves, what happens when a firm goes dark or goes private? And going dark means that firms move to an exchange where there is no disclosure requirement, like over-the-counter bulletin board, whereas going private means that the firm, through typically an LBO or an MBO, decides to no longer be publicly traded and therefore becomes exempt from the disclosure requirement of its regulator. So just to remind you all, what you probably know is the following, that in the US, private firms generally do not have to disclose, whereas in the European Union and the UK, private firms above a certain size requirement is mandated to disclose every year. In contrast, for public firms, firms with stock listed on a stock exchange, the pattern in the empirical data is more varied, because generally US firms listed on the large exchanges must disclose every quarter in the lower right corner. However, public US firms listed on the small exchanges like the OTC, the over-the-counter bulletin board, they must not necessarily disclose. And then in the middle, in the lower row, is the EU and the UK firms that are required to disclose every quarter. So we believe that our model setting here, our modeling approach, has some potential implications for empirical research and perhaps for regulators as well. So first, prior research, such as Owen Penman 1989, analyzes how the stock returns vary with the underlying accounting variables. And recent papers allow for a nonlinear association between stock returns and the underlying fundamental accounting variables. One paper was presented by Oliver Binns in this seminar series recently. Now, our paper offers a supplementary approach, which is that you can use peer firms' information as a substitute potentially for disaggregating accounting information, as is done in the papers mentioned above. Our second potential implication is based on the empirical literature about firms that go dark. And so in particular, Boucher and Leutz 2005 investigated what happens to US firms when they suddenly faced a mandatory disclosure requirement. And they find that some firms choose to go dark and others adhere to this enhanced disclosure requirement. In a related vein, Burnett 2020 documents that for US firms that are not subject to disclosure requirements, still information makes it into price. And he makes his investigation, empirical investigation, by looking at firms that did not have to disclose in the year before they became subject to mandatory disclosure requirements, and then shows that after we see what they would have disclosed as a counterfactual, that the stock prices varied with the undisclosed information. So accounting information finds different ways to make it into the stock returns and stock prices. Third, our last result in this paper has implication for the firms that disclose with different frequency. And in a recent accounting review paper, Arif and DeGeorge, 2020, they argue that US firms that disclose every quarter affect non-US firms that disclose semi-annually, such as Australian and EU firms, more with intra-industry information transfers in those quarters where they don't disclose. So what does that mean? Two firms with a December 31st fiscal year end, when the US firm discloses its first quarter earnings, that disclosure has a higher effect on Australian and EU and UK firms than when the US firms disclose their second quarter earnings. The reason being that at the end of the second quarter for the US firm, a firm with a similar fiscal year end in Australia, in the EU or in the UK would have disclosed its semi-annual report, and therefore the need for information being used from the US firm to value the Australian, EU or UK firm is less important. Now, their paper investigates for excessive information transfer, but we establish in this paper what is the normal expected level of information transfer. And so I guess it's time for my first question in the chat.
Hi, Bjørn. Shidapta here.
Yes.
I was wondering what firms that are cross-listed in the US So EU firms, Australian firms, whatever. Two, are they required to disclose quarterly or semi-annually?
Well, it depends. If a non-US firm is listed in the US markets as a foreign private issuer, then they are subject to the same disclosure requirements, generally as in their home country. However, there are exceptions. And one exception is that a foreign firm, foreign private issuer, a non-US firm listed in the US markets, if it looks too much like a US firm, it can lose its foreign private issuer status and become subject to both switching, if they're Australian, from IFRS to US GAAP, and having to disclose using quarterly filings with the SEC on a 10Q form. So some foreign firms have to disclose quarterly, but only those that lose their foreign private issuer status.
And what about Canadian firms?
Canadian firms are different because under the multi-jurisdictional disclosure agreement, again, assuming that they didn't lose their foreign private issuer status, they disclose as the same frequency as back in Canada, which is quarterly. So the disclosure requirements of the home country carries over to the US.
Okay, and so that would mean that you should be looking at both US and Canadian firms for the main test, or you just want to look at only American firms?
Well, I mean, Arif and DeGeorge did an empirical analysis where they separate the firms based on whether they disclose quarterly or not. And of course, there are some non-US firms in the EU or the UK that were required to disclose quarterly for a while, but that requirement disappeared. But the firms opted to continue quarterly reporting. And so what Arif and DeGeorge show is that firms that disclose quarterly affect firms that disclose semi-annually more at the end of the first and the third quarter, assuming they have the same fiscal year end.
Okay. Thank you.
Thank you. Joshua?
No, I was about to ask a similar question, so go ahead.
Thank you. All right, so we all know that accounting serves two roles, and one role is contracting, which we're going to abstract from here. But we're going to take the valuation perspective of accounting, and we're going to build on prior literature. And just to make sure that we give credence to that, here's sort of a list of papers, the early Preinreich papers about residual income, the Piesnel paper from 1982, the Olson 95 paper that introduces linear information dynamics, and the Feldman-Olson 95 paper that articulates clearly what happens to those earnings that are not paid out as dividend in each period. Namely, they are reinvested in the firm without any excess return, without any abnormal return. And then O'Hanlon and Piesnel that articulates how book value evolves over time under the assumption of clean surplus. And in addition to those papers, those six papers that rely on clean surplus and are based on abnormal earnings or residual income, there are recent papers like Olson, Jetner, and Roth that talk about abnormal earnings growth, Olson and Johannesson, and Lai that reconciles Olson, Jetner, and Roth with Olson 95. So all of these papers are in our background in terms of prior literature, but we mainly rely on the literature that presumes clean surplus accounting. There are also some papers like Colin Klopp's work that tries to investigate the boundaries of the assumptions. Do we really need clean surplus accounting? But just so that everyone's on board, when I wanted to sort of kick it off with a quick review of the Olson 95 model. So in the Olson 95 model, we have basically 4 or 5 variables. We have the market value P, we have the book value B, we have the earnings X, and the dividends D. And so what we do in this literature is we calculate the abnormal earnings, which is the earnings less some discount rate R multiplied by the beginning of that period book value for which earnings is measured. And in this literature, there's sort of a use of capital R in the work, which is 1 plus the discount rate. But lowercase r is the discount rate. And in this literature, the assumption is let's use clean surplus, because we believe that while it doesn't hold perfectly for our accounting numbers, that it's a good approximation. We know there are deviations, but let's take it as an identity. And so what does that say? It says that in sort of casual words, the ending book value of the firm is equal to the beginning book value plus the earnings less the dividends. But by adding up and subtracting lowercase r times the beginning book value, we can rewrite that equation of the ending book value, which is a pure flow equation for the balance sheet account of equity. We can rewrite it as 1 plus lowercase r, or capital R in green, multiplied by the beginning book value plus abnormal earnings less dividends. So the first term, capital R times the beginning book value, takes the beginning book value and takes its forward value 1 year hence, its future value 1 year into the future. And then the Olsen model reassembles this version of clean surplus relation. It basically takes the ending book value on the left-hand side and moves it to the right-hand side. And it takes the dividends on the right-hand side and moves it to the left-hand side. Now we have dividends in the last line of this slide expressed as 3 terms. The first is the beginning book value in future value terms 1 year hence. The second is the abnormal earnings, and the third is deducting the ending book value. And so in the Olsen model, this of course is done in terms of notation. And so when you have one firm, you can think of this perhaps as operating activities, but let's label that one firm by J as a firm subscript, and let's label T as the time, say the year for each period. And then we have book value B with subscript J and time T, same for earnings and same for dividends. And what we mean by dividends in this literature is dividends net of capital contributions to the firm. And so clean surplus relation, that assumption that we started with before, can therefore be written formally as the ending book value of period T, which is B subscript J as a function of T on the left-hand side, is beginning book value plus earnings less dividends. And reassembling, rearranging terms like we did before, clean surplus can be expressed in terms of abnormal earnings. And then we can sort of set the clean surplus equation up in such a way that it becomes dividends, as we saw, equals the beginning book value at its future value plus abnormal earnings less book value. That's at the end of the period. That's what we see by the red arrow. And now Olsen 95 makes a different assumption, an additional assumption, I should say, which is Olsen 95 assumes the present value of expected dividends, which is that we value the firm ignoring risk aversion, but that can be fixed and has been fixed in other work, as the discounted sum of the expected future dividends with the known discount rate that's assumed to be not varying with time and flat over time. That's really saying that these markets are fully informationally efficient at any point in time. You take all the information that's available and you value the firm accordingly. And say, so substituting the clean surplus relation as we sort of rewrote it into the present value of the expected dividends, we get the telescoping sum that you see right here, that each of the dividends for period T plus 1, which is the first term, T plus 2, which is the second term, and T plus 3, which is the third term, in each of those dividend terms, the ending book value to the left of each of those dividend expressions is exactly offset by the beginning book value in the next dividend expression. So what we see that here is that for dividends 1, the BJT plus 1 in the first ratio cancels out with the next red BJT plus 1 coming from the dividends of period 2. And so the red, the blue, and then so forth, the green book values in the future cancel out except the initial book value. So we get the value expression in Olsen that the price is equal to book value plus the discounted sum of all future abnormal earnings to infinity. And if you don't like infinity, we can put in a terminal value expression as we do this valuation. We haven't done that here. Now, in addition to this expression, we can rewrite the value of the firm, which was the price in the last equation. We can divide by the book value in red and calculate the market to book ratio. Ayum?
Okay, Ron. I have a question about this OSINT. So compared to the model you are presenting today. So we all know that I think for students to kind of follow this OSINT model, the difficulty is to estimate this expected abnormal earnings, right? And one way to think about that is that practitioners, analysts need to consider all the information available out there to come up with their guess, the best guess of these abnormal earnings, including, for example, some other firms who have issued information at a time when the cover firm is not issuing. I think my question is that potentially one way to think about this issue is that this expectation abnormal earnings is conditional on many different sources of information. And that potentially is another way to interpret this model. And then your model is just try to explicitly talking about there's one particular source of information is another for-profit corporation located in maybe in another jurisdiction or regulated based on a different disclosure frequency. And then that's one way more explicitly talking about how do we estimate one particular firm J's abnormal earnings.
Yes. So let me confirm how you frame it, because we think about it that way as well. In the Olson model, although this is a stylized version, there's also other information that I will get to in a second. And that other information is assumed to move freely. What we are really introducing is the possibility that the other information is also following some clean surplus assumption. And then we show what happens to the Olson model when there's both other information that does not adhere to clean surplus and other information that does follow clean surplus, because the other information is the performance of the peer firm, some firm that might be in the same industry. That's exactly what we're trying to achieve. We're imposing two assumptions of clean surplus, one for the firm at hand and one for the other firm, in order to articulate exactly how much intra-industry information transfer would we expect when we have two sets of clean surplus assumptions.
Thank you.
Thank you, Joshua.
Yeah, thank you, Bjørn. So just a very basic question. The Olson model assumes information symmetry, right? So
Yes.
What that means is that for his model or your model to have any empirical validity, you really have to take into consideration the possibility of earnings management and manipulation. And there are papers suggesting that manipulation is contagious, which means that if firm A knows that firm B is manipulating, given some assumptions, then firm A will manipulate more if firm B is also manipulating. Well, that means a different kind of equilibrium, which has implications for the observed stock prices. So are you suggesting that this linear information dynamic model, assuming full information symmetry, that is, it rules out the possibility of manipulation, has empirical validity in the sense of correspondence with actual observed stock prices?
Well, first, let me agree that there's work that says that earnings management is a pressure within an industry or among your peers. So for example, Gil Satka has an early paper around 2007 in a law journal to that effect. And also Essie Einhorn recently has joint work with some of her colleagues, I believe, on the issue of how earnings management can happen in such a setting. So certainly earnings management is something that's subject to the who's your peer and what you are expected to deliver in terms of return. However, the Olson framework ignores earnings management, and its stylized version here is simply saying that whatever way earnings may evolve, the last line in this slide indicates how you should price the firm. And so if there is earnings management, that is not to say that there isn't information asymmetry between the manager who made the reported earnings potentially deviate from what he or she knows for it to be the true value. There could be room for insider trading. That's not in the Olson model. However, the Olson model says if the people committing earnings management lead to earnings that have this process, still this is what value should be, because the Olson model is a representation theorem that says that the intrinsic value of the firm on the left-hand side, the price, PJ, must be the book value plus the discounted sum of the future expected abnormal earnings. The fact that there might be earnings management affect the expectations that you form about the future abnormal earnings, but it doesn't invalidate this relationship. Because the relationship, the expectation in the last term of each of the future abnormal earnings should then anticipate that the investors understand that there might be some earnings management and that would have an effect on the future reported abnormal earnings. But earnings management doesn't violate clean surplus, right? You're not saying fraud, you're merely saying abnormal earnings, but clean surplus still holds.
No,
That's
except that, so
say.
there is a recent paper by Ping Yang in the Accounting Review suggesting an equilibrium whereby manipulation would essentially affect prices in a non-linear fashion. In other words, the linear dynamics may be violated to the extent that there is earnings management manipulation, and that manipulation in fact involves information transfers. So essentially investors, knowing that firm A manipulates, adjust their expectations of future cash flows of firm B, which as a result of assessing properly that firm B will also manipulate to some degree. So that equilibrium somehow violates the linearity assumed in the Olson model.
Well, I don't, so since I'm not familiar with Ping Yang's paper on this topic, I can't speak to that, but my sense is that it's perfectly possible that the linear information dynamic doesn't hold even for a single firm, but the linear information dynamic is a vehicle to come up with a simplification which can be used by empiricists to specify their econometric analysis and understand how much should the earnings response coefficient be when a company announces its earnings. So I think the Olson model's power and weakness is exactly that it doesn't talk about incentives or contracting at all. But the power is also that in a parsimonious manner, it gives us some guidance for a perfect world where we can have empirical specifications that are grounded in, I'm going to use the word theory cautiously here because there's no optimization, but still it's a representation theorem of the consequences of clean surplus. So if you grant Olson, because we're still in Olson's world, that he didn't specify the process of the abnormal earnings, then it could be anything. It's hidden in the expectations what the investors do with the possibility of earnings management.
Fair enough. Thank you.
You bet. But that's a big topic that we can't fix, right? We got to fix one thing at a time.
Yes.
So here's what we're going to do. We're going to follow Penman's paper, and we're going to divide book value through in each of the terms here to get the market to book on the left-hand side, price divided by book. That's the MB, market to book. And what does it equal? Well, it equals 1 plus the discounted value of the future abnormal return on equity. And what's the abnormal return of equity? It's the return on equity less the cost of capital in percent, which is the threshold at which we should evaluate it. But Penman shows that, as you see in the right term with green letters, that it's not enough to merely discount future abnormal ROE. You have to correct for the fact that the firm might grow in its book value over time if it doesn't pay out all its earnings as dividends, and that should be taken into account. when you think about the market to book ratio. So again, the market to book ratio in a single firm setting is the 1 as a benchmark if there's no future abnormal return on equity, and then the discounted sum of growth in book value multiplied by the abnormal ROE. So now we're getting to what we do. We take the Olson model, which is a model with linear information dynamics, and we extend it to 2 firms. And so to do that, you see here the linear information dynamics that we assume. And we use the Olson notation as closely as we can, right? So J is the subscript for one firm, and K is a subscript for the other firm. And firm J's abnormal earnings, which is on the left-hand side, X superscript A subscript J, the abnormal earnings of firm J evolves over time based on its own previous abnormal earnings with the coefficient omega JJ that is not in red. But what we do is we add the possibility that the other firm's abnormal earnings, XKA at time t, helps predict firm J's abnormal earnings in the next period. And that's the coefficient in red, omega subscript JK. And we call this direct interfirm information transfers. And then we abstract initially from any other information just to see the effect of having 2 firms. So each of these 2 firms have abnormal earnings and clean surplus accounting. But what's different is that each firm's abnormal earnings works as other information for the other firm in terms of valuation. And then what we do is we solve what would the prices be following the approach in Olson, but with the added assumption that you have clean surplus for both firms. And what we get is that each of the 2 firms now depend in terms of price, not only on its own book value and its own abnormal earnings, but each firm also depends on the abnormal earnings of the other firm that is publicly disclosed at the same time. And so the addition to Olson is the fact that when we have a coefficient, the coefficients omega here in red, when they are not 0, both of them are not 0, then we get that the coefficients in green, which is evidence of information transfers, are also not 0, but we solve the alpha coefficients, and that's part of theorem 1. And once we've solved how abnormal earnings of each firm, as well as the firm's own book value, are needed to value the firm, now we're ready to proceed. We are ready to proceed to returns, because stock returns is what empiricists typically use for their empirical analysis. But I just want to note that there's perhaps one thing that is a little surprising here, that when you do the levels regression of price on book and abnormal earnings, or earnings changes if you like, then the price of the firm does not depend on the book value of the other firm. The book value is an anchor for valuation, but only the book value of the own firm. And I also want to note that we can expand this model from 2 firms to 3 firms. So suppose you had 3 firms, J, K, and H. You could have direct interfirm information transfers between the 3 firms and still solve the model. I'm not going to show you that because we're going to turn to see what would the market to book ratio look like when you have interfirm information transfers.
Yeah.
So as a corollary, we show that the market to book ratio of firm J depends, as before, under the assumption of linear information dynamics, on the abnormal return on equity of the own firm, that's the term in green, and the abnormal return on equity of the other firm, that's the term with the red alpha in front of it.
So, Bjørn, there is a question
Yes.
that thank you.
Yes.
Can you please go back to your LID and linear information dynamic, please? Yeah. Okay. Because you don't have any empirical data or test result. So I just wonder whether this, omega JK, omega KJ is any significant the result at all. Because I think some years ago, I did try this information dynamic. I found this omega JK and omega KJ is basically it's very, very small. And also the signs are not predictable. So I'm not quite sure whether you have tried any firm at all for this information dynamic.
Well, so this is not an empirical paper, right? But you need to pick pairs of firms where you extend to believe that the abnormal earnings of one firm affects the future abnormal earnings of the other firm. So for example, pick two firms who are in a duopoly or something that resembles it. Then if it's a duopoly where the products are substitutes, then when firm K does well in one period, it might predict that the other firm J will perform poorly in the next period if their products are substitutes. Conversely, if the products are complements, sales by one firm in period T might predict better abnormal earnings for the other firm in period T plus one. So if you do the empirical analysis in the cross section, there might be some firms where the products are substitutes, some where they're complements. And then you might find on average, the omega is close to zero, but you have to pick the pairs of the firms and sort them based on whether the products are substitutes or complements from the perspective of imperfect product market, microeconomics.
No, I tried for this cross-section analysis. Basically, is quite difficult to get any sensible result. For time series, if you choose any two firms and do this time series relationship, this is regression, I found this omega JK and omega KJ is just not significant.
I'm not doubting if you choose two randomly chosen firms that you're challenged to find a significant direct inter-firm information transfer. But if you pick two firms that are locked against each other, for example, there are two large auction houses in the world, right? And they compete for selling the estates or arts of the well-known people in an auction, and they compete directly for the sale to be made. And then clearly either one of them, it's a winner takes all, right? One of them wins a particular auction or not. And so there's no way that this omega wouldn't be negative. Does that kind of make sense? That on a priori grounds, you can sort industries based on the type of interaction they might have with their peers, their competitors, but it could also be in the supply chain.
Do you have any prediction about a sign, even sign of this omega JK or KJ?
No, we are deliberately agnostic about what that sign would be. There is prior economics literature that addresses this issue. For example, Simi Ketja notes that on a different topic, relative performance evaluation between firms, the predicted sign of the relative performance evaluation depends on the type of product market competition that they have with each other. We don't have to give the sign, right? That's outside the realm of this framework. This is a representation theorem that's supposed to apply whether the sign is positive or negative.
Okay, thank you.
Steve, are you next?
Yes, I am. I'm sorry if this question may have been answered. I joined a bit late. In the Olson model, there is this linear information dynamics in these abnormal earnings, but there's also this other information floating around, okay?
Yes.
That's not captured in the accounting system, and that feeds into the abnormal earnings T plus one. So is there any assumption on here about how that other information feeds in? You're just brushing it under the carpet, or is there an assumption here that this doesn't matter, or has to be an assumption here about how this is working?
This is our benchmark case where we muted other information, but we will give you two settings with other information, one in which the other information is firm specific, as in the Olson model, but also one where the other information is common. And we solve each of those two cases separately because they have different predictions, but it's coming up.
Okay,
so
thanks very much.
We'll do exactly what you want, I hope. Joshua?
Let me just go back to my earlier question in the context of the linear dynamics. So if again there is manipulation by companies, the effect of the abnormal earnings or the apparent disclosed abnormal earnings of company A on the valuation of company B will depend on the assessment of the market of the probability that company A manipulated, and hence on the sort of the equilibrium reaction of company B to the manipulation of company A. What that suggests is that there is no linearity here, because the assessment of the information of company A and its impact on company B will vary depending on characteristics of the companies and their probability of manipulating. Is that correct?
Yes. Excuse me one sec. Apologies. Yes, it will vary with those probabilities. There's another question in the chat room that I can't see.
So Christina had a question.
Yeah, it was not really a question. It's just, something that came up to my mind when we were talking about contingent earnings management, because that's something that I experienced at firsthand when I was working, in a bank. We were doing exactly that. We were observing, the peers and adjusting our earnings before reporting. Yep. So we're doing a bit of this. But so, if this, codages, exist, then, what this linear dynamics, tell us. But I think, Joshua Reiner has been quite, interested in this discussion as well. So there is no point to answer, honestly,
And there's another question in the chat, please. Joshua?
Sorry, no, I asked my question.
Yeah.
Okay.
So Bjørn, Rich had actually a general question, and there was some discussion then going on following up on Rich's question.
Yep. Rich?
Bjørn, wonderful to see you. I just wanted to get your impression as to why people no longer do any time series analysis in the accounting literature. I think it's like you're trying to bring that back and put a lot of structure on it via this. And maybe
yes,
there were reasons why we don't do this anymore. Maybe they weren't good reasons, but what was your impression of those?
Well, so your own work, Frankel and Lee, right, is taking analyst forecasts. And you're right, we're trying to introduce sort of the opportunity to do structural estimation, where you estimate the omega coefficients here for the abnormal earnings process to identify pairs of firms that you should value jointly, and then estimate the coefficients that we predict in the theorem in order to value the firms. And I actually don't know why papers like this was abandoned. So one thing, of course, that has happened is our computing power has gotten better. Another possibility is that the taste function of the accounting research has gone different routes than the pure play valuation. But we think that there are still papers written about valuation and value relevance. And in order to assess the degree of interfirm information transfers that we would expect, we need to have a benchmark, and we just are trying to create benchmarks like this. And then we think that it's needed to articulate whether the common information is firm specific or whether the other information is common for the two firms. But really, this paper could have been written 15 years ago, right?
Well, let me suggest that maybe it started with Steve Penman, but other papers, especially the Sloan paper, just said, you know what, we're just going to use firm characteristics because these time series parameters are perhaps unstable.
Mm-hmm.
And we'll just tell a story for why this firm characteristic is associated with more or less persistence. And so I'm just not sure if we could ever estimate these parameters. And if so, if they'd ever, you know, what kind of empirical insight we can gain from that.
I mean, there are two things. One is whether the time series process in the linear information dynamics or in the abnormal earnings process is stable over time. The other is, can we expand it to include more lags of abnormal earnings and still do similar predictions? Absolutely. Work by Jeff Callan. Callan and Morell has done work along these lines. So it can be expanded to consider these other issues. I think there's in general, as you suggest, a lack of belief in time series analysis in accounting, but still there are people like Catherine Finger who did analysis of the evolution of earnings over for a sample of firms where we had 50 years of accounting data in order to understand from those long-lived firms, what do the earnings properties look like? So it's not that it can't be done. She sorts firms into those where earnings are stationary, where they're integrated order two, or just I mean, that work too has had an influence, right? And she can estimate it reliably for her hand-collected sample of firms.
Well, let me kind of put it a different way. What if you just had a firm with like a liquidating dividend in period 3 or period 2, and you just had another firm in there, and you're just going to look at correlations between noisy signals of that liquidating dividend? Wouldn't you find similar results as you're finding now?
Absolutely.
Yeah, there's a lot of structure here. I just wonder what the payoff is for that.
So for example, we could take the approach that Russell Lundholm takes in his discussion of Olson 95, where he expresses the Olson model as a 3-period model. And we could make that into 2 firms and then have the effect of intra-industry information transfers with the interim date 2 in a 3-period model, get qualitatively the same results. But the reason Olson did it this way is because actually, even though it's harder math, the sort of empirical representation of the results are closer to the way empiricists think about the use of the data. Right, so we're, in a sense, we're relying on the fact that people before us who did empirical analysis, like George Foster, regressed returns on the earning surprise of that same firm and the earning surprise of another firm. Like, we're relying on prior empirical work to try to give them guidance to the benchmark level of coefficients that can be determined based on the coefficients in this equation, which can be estimated. Is that good, Rich? Awesome.
Yeah,
okay.
I think, well, I think the answer to the question is that, you know, if you've got a time series just in earnings or earnings and book values, as you're here, is very limited information. And the key is expanding the information set, actually getting to that other information, which is in the linear information dynamics. It's floating around outside, but the other information, of course, also includes the line items of the income statements and balance sheet. So the key to the forecasting is to actually expand from some univariate time series, as it were, to enlarge the information set. That's been the trend.
Yeah.
And that's bringing the other information into the prediction.
Yes. So let me just wrap up the baseline case here without other information and then get to that. But I agree with the point that other information has been studied by, like, James Myers, right, in his dissertation work in the accounting review. But just to wrap up the baseline case, without other information, we can rewrite the market to book ratio as depending on being 1 plus 1 coefficient on the abnormal return on equity for the firm itself, and then another coefficient of the ROE of the other firm, but we have to, of course, to scale the book values as Steve does in his earlier work. And then we can, for the firm with intra-industry information transfers that are direct without other information, we can model the 1 period ahead stock return. And the way that's done in this literature is to make it excess stock return. So we deduct the prior price times 1 plus R. And if we do that, then the stock returns depend on the innovation in the own firm's abnormal earnings in the first expression and the innovation in the other firm's abnormal earnings. So earning surprises from both firms affect stock returns, even in the benchmark case without other information. And then we can do sort of the Easton, Harris, and Olson, that we can ask the question, what happens to stock returns when you go, instead of 1 year ahead stock returns, do 2 year ahead stock returns? And now we turn to other information and we consider 2 cases. In the first case, we consider common other information like regulation, macroeconomic factors, industry or sector information that is considered in the prior literature. And so to model other information, again, we follow Olson. We have this V that's in blue here, the added term in the linear information dynamics, and we assume, as does Olson, that this other information as an approximation, as a first step, follows an AR1 process with a coefficient gamma that's in orange in the last equation here. And then we resolve the model from the baseline case. We solve again that prices depend on own book value, own abnormal earnings, the other firm's abnormal earnings, and the other common information. And we show how the other common information is valued by each firm through the coefficients. Let's focus on beta J in yellow. Those coefficients depend on the underlying linear information dynamics and depend on the gamma, which is the persistence of the common other information. And then we solve what will the stock returns for 1 year look like when you have common other information. And it's noteworthy that the beta J is the same. And then we show when you have common other information that if you form a value-weighted portfolio, then the only information that affects the value-weighted return is the common other information in each.
There is another question by Google.
Yes.
All right. I just type in the chat box. Basically, I know your model is built in a risk-neutral economy. So you assume that every firm has the cost of capital, basically risk-free rate. So certainly, based on your return model, expected return will certainly equal the risk-free rate for every firm, right? So you talk about this unexpected return. Why this is important then?
You're right that the Olson model generally assumes risk neutrality, but then subsequent work to the original Olson paper allows for the use of risk-adjusted variables and risk aversion. And in order for us to care about diversification or the properties of the value-weighted portfolio, you might think that we need to actually model the risk aversion explicitly, but our view is that it's worth understanding what the value-weighted portfolio looks like even without risk aversion, because we know how to adjust for the presence of risk aversion. It doesn't change the argument here. The argument here is driven on the properties of the return of a value-weighted portfolio, which is what the CAPM predicts. And all we show is that the fundamental abnormal earnings innovation for each firm washes away when you form the value-weighted portfolio, but what survives is the last term, the innovation to the common other information. That's the fundamental information that survives.
Okay, thank you.
And we don't need risk aversion. We could do it. We could put it in it. And in fact, Olson had an earlier working paper of his 85 paper where there was the assumption of each investor has exponential utility function and everything is normal, but that is not the essence here, right? The essence here is just to show what happens when you form a value-weighted portfolio. What is the properties of that portfolio? And the property is that only common other information survives.
Okay, thank you.
Great. The next thing that we do is we look at firm-specific other information. And again, that has been suggested by prior empirical literature, things like order backlog, new patents, newly signed contracts. So we introduce two different pieces of other information, one in light blue for firm J and one in darker shade of blue for firm K. We resolve the valuation formula. And then we find, again, that the weight on abnormal earnings in valuation is the same, whether the information is common or firm specific. But we find that the weight of firm specific other information the weight on other information is different for the two sources of information. Okay, thank you. Then now that we've solved that issue with firm-specific other information, we've derived the valuation formula with two firms. We also do it for stock returns in each of those cases. The remaining of the paper sets out to study what would happen when firms disclose with a different frequency. And as I discussed at the beginning of this talk, there's variation between the US, which mandates quarterly reporting for public firms, and the rest of the world. And there's even variation within some stock exchanges, like in Singapore, where some firms must disclose quarterly and others do not. And so what we model is a setting where you have spillover effects between the two firms that we consider. One of them disclose quarterly, like the US firm, at the end of each of quarter 1, 2, 3, and 4, it provides earnings and book value. The other, like a UK or EU firm, discloses only at the end of quarter 2 and the end of quarter 4. And then we show in the paper how we would value a firm at the end of quarter 1 compared to at the end of quarter 2. And we show that by basically solving the model without information being provided, and we come up with these expressions that are in the paper as to how to value firms that disclose with a different frequency. And our implication is that one should use prices for valuation, not stock returns, because the stock returns, both at the end of quarter 1 and the end of quarter 2, are affected by the presence of a non-disclosing firm. Finally, the last set of results in the paper considers how we should value a firm that once used to be public, but subsequently went private based on a clean surplus assumption. And so here's what we do. We consider firms that go dark or go private. So one firm, say a public US firm, continues to disclose with the same frequency every quarter. The other firm, the US firm that used to be public but went private, we have a book value for that firm that becomes more and more stale as we go forward in time. But we show that the information that the firm that's private, even though it doesn't disclose, we know that clean surplus holds, and assuming parsimoniously that there's a linear information dynamic, we can derive a valuation formula, and then we can derive how stock returns behave when one firm discloses and the other does not. And what we find is that there's learning effects that leads to predictability in returns, even though this is a market that is informationally efficient. That result is in corollary form. The returns of each firm become correlated over time. So to summarize, this paper takes the Olson 1995 paper, where price is equal to book plus the discounted sum of future abnormal earnings, and there's linear information dynamics added, and asks what would happen if we had two or more firms. And we have to be explicit then about whether the other information is common or firm specific, because that leads to different valuation formulas. And we show that a value-weighted portfolio, when there's common other information, is only affected by the shock to that other information, is not affected by the firm-specific shocks or innovations to abnormal earnings. And then We showed how to value firms when they disclose with a different frequency and how to value firms that used to be public but went private. And specifically, we show that the further you get away from the time when the firm went private, there's an effect then on the valuation of the firm. At the end, I'd like to remind you that the next presentation in this series is at a different time because our presenter is in Hong Kong. And it's on December 2nd, starting at 9 a.m. with Guochang Sheng. Thank you very much.
Thanks, Bjørn, for the presentation and the talk. So that is ending our session for today.